We've got gold prices. And in fact, I looked at them yesterday. I had thought that the last 2 years, gold had been trading within the $1,700 to nearly $2,100 range. And that's true. It has, and it has broken down. This is a really good leading indicator of inflation. What caught my surprise yesterday was looking at where gold was in 2011. It was roughly this level. So you can say since 2011, more than 10 years, we haven't had a big breakout in the gold price. And that is informing our decision here. Gold is a leading indicator of inflation, and it has not broken out. It is breaking down. And then the second thing that we're looking at is the inventory glut around the world. And especially in the United States, it looks like some of the best supply chain managed companies in the world over-ordered. They ignored their automated enterprise resource planning systems, so ERP systems, and double-ordered, triple-ordered, so that Nike, for example, its sales were up only 3.5% globally last quarter, and yet its inventories were up 44%. And in the United States, they were up 68%. And if you look at in transit, they're up 85%. So that's just one indication. We're seeing lots of inventory overhangs. And even online sales are suffering. Amazon just had its second Prime Day, and it showed no increase, which is really from a year over year, which is telling us that either units are down or prices are down. So I think the CPI is a lagging indicator. It always is a lagging indicator. And we're seeing a lot of prices in the pipeline that are falling. We compare what Chairman Powell is doing to what Chairman Volcker did in the late 70s, early 80s, when he was fighting an inflation problem that had been building for 15 years. Vietnam War, Great Society, closing the gold window. That was a real inflation problem that built up over 15 years. This inflation problem has been 12 to 15 months by the time the Fed started addressing it. And we think it's much more a function of supply chain imbalances caused by COVID, and then again by Russia's invasion of Ukraine. These are very, very different circumstances. So what the Fed has done this time around is it has increased interest rates. If they go another 75 basis points, which is very likely on November 2nd, they will have increased interest rates from 0.25 to 4%. And that's a 16-fold increase. What did Volcker in the early 80s? He took interest rates from 10 to 20%. That's a twofold increase after consumers and businesses had gotten used to dealing with inflation and working around it over 15 years. This is a real shock to the system. And I do believe we will see the ramifications in many ways. We're seeing housing shutting down. And I think we're going to see a lot of other activities shutting down as well. We believe we're in a recession, and we believe this recession now will be sustained. And if we see an increase in GDP, it's probably because either inventories are continuing to increase or imports are coming down as companies try to unwind their inventories. What's interesting, I think many people are coming around to the idea that we're in a recession or we're going into a recession. The first two quarters with real GDP growth negative to us means we're in a recession. And now that many people are worried and are beginning to see recession for as far as the eye can see, we are looking at this recession a little bit differently. We think it's going to be a function of this massive inventory overhang, and that it's going to be a serious inventory correction. So now that many economists are starting to agree with us that we're in a recession or going into a recession, we feel that they might become a little bit too alarmist if this is just an inventory recession. And I think the Fed will have a lot to do with whether or not it is. This is a shock, though, to the system. And this idea that we have an inventory overhang, we think it's going to get bigger as consumers pull back. Low saving rates, 3.5% versus 8% where it was before COVID. And so we'll see. We think this holiday season is going to be pretty tough. And we also believe that innovation solves problems. We had a tough time going into COVID with our kind of strategy. And then we had a boom in our strategy during COVID because guess what? We needed the genomic revolution to help sequence the coronavirus and figure out tests and vaccines. And our kinds of companies helped with that. We think with supply chain issues and with the food and energy prices caused by this shock, this Russia's invasion of Ukraine, that once again, innovation is going to help solve these problems. Electric vehicles, there's an accelerated consumer preference shift towards electric vehicles, like Tesla, because of oil prices. And we think there's no stopping that trend now. And in terms of food prices, we do believe that gene editing is going to help us figure out how to produce crops in areas that are less fertile than the Ukraine, the breadbasket of Europe, with less water, less fertilizer, less pesticide. So we're going to continue to see the miracles associated with the genomic revolution, but our other strategies as well, whether we're talking about robotics, solving the labor shortage, energy storage, I mentioned electric vehicles, pulling us away from oil consumption, artificial intelligence, which is going to help every company become more competitive if they use their data and combine it with other data in effective ways. And then blockchain technologies, which is going to take the middlemen out of a lot of businesses and take the cost out of a lot of businesses, helping us to solve this inflation problem. So we think innovation solves problems. It certainly gave us an appreciation of that during COVID. Our strategy was high flying. And we think we have even more problems right now. Certainly all stocks are experiencing difficulty in this environment as the market tries to understand how far the Fed is going to go and how deep this recession is going to be. So Tesla, as I mentioned, is a solution to the problem. It's very interesting. If you look at gasoline demand this summer in the United States, it dropped below COVID levels, the worst of COVID, and it dropped to levels that we have not seen since 1997. That's real demand destruction, and it couldn't have happened, we do not believe, without electric vehicles at the margin taking huge share from traditional automobiles. So if we had to be concerned about an industry, it would be the traditional auto industry. We think that gas-powered vehicles are going to be obsolete within the next 5 to 10 years, and the traditional auto industry has to figure out a way to migrate into electric vehicles and into the next big phase, which we think Tesla is leading, the autonomous taxi platform phase. So lots of changes here. Traditional industries are in harm's way as innovation pushes through, accelerated by some of the turmoil out there. We have a 6-metric scoring system, very much focused on innovation. One of the scores is thesis risk. Thesis risk has a lot to do with government policy. And so in the early days of ARC in 2014-15, we were thinking, okay, government may be very concerned about the safety of autonomous vehicles. But as we've moved through these last 8 years, what we've seen, thankfully, is the government and regulators in particular, very focused on data. And what does the data say? The data says that most fatalities and accidents, 85, almost 90% of them, are caused by human error. If we take the human being out of the equation, then we're going to save up to 35, 40,000 lives in the United States, the fatalities per year, and up to 1.25 million around the world. So that is a noble goal. So we're very focused on what governments are studying in terms of the data. And if they stick to the data innovation typically it solves problems and makes the world a better place.